we have a belief that how you make money is just as important as making money. And so again, there are products and services that we sunset, that we discontinued, that just didn't align with the values that we hold about how we make money and how we serve our members.
The Digital Banking Podcast is powered by Typhon. Typhon is the creator of Infinia, a dramatically better digital banking platform for community financial institutions, as well as several platform-agnostic, revenue-generating point solutions. Our highly configurable platform and broad ecosystem of third-party partners ensure our entire suite is scalable and extensible to meet the needs of any FI. On our podcast, you will hear host Josh DeTar discuss today's most pressing financial technology topics with seasoned industry experts from every possible discipline.
You know, your podcast hasn't officially made it until there's ads in it. But this is one you're not going to want to skip past. And, well, if you do, feel free to hit that fast forward 15 seconds button twice. Ever wonder what gives me my energy and enthusiasm during these podcasts? You know, outside of my relentless desire to learn about, connect, share, and build up community FIs and their mission to support the communities they serve? It's coffee, and lots of it. Now, you want to know what's better than your regular old coffee? How about donating $5 to the Children's Miracle Network hospitals through credit unions for kids every time you purchase high-quality, ethically sourced coffee that also provides living wages to coffee farmers? So if you want to listen to this episode with epic levels of caffeine-induced focus and help kids in need, head to javaforkids.org to learn more and buy a bag or 10. Thanks.
Welcome to another episode of the Digital Banking Podcast. My guest today is Kendall Garrison, the CEO of Amplify Credit Union. And y'all, I got myself a real live cowboy on the podcast today. And I don't just mean that because he's a lifelong Texan. Now, the awesome accent doesn't hurt, but I say a real life cowboy because Kendall is coming out guns a-blazing, pointed straight at doing things the way we've always done them. A topic of much conversation on this podcast, I really do love to get unique perspectives from folks actually putting this into practice and moving with purpose towards action. Now, when Kendall was being interviewed by the board of the credit union for the CEO role, he told them straight up, much like he likes his whiskey, that if you want a defender of the status quo, someone who sets it on autopilot and runs the standard playbook of every other CFI, we can just end this interview now and y'all can go look for someone else. You see, Kendall is unabashedly, ruthlessly, and radically passionate about and focused on the core credit union mission of improving the financial lives of members. That's job number one. But how do you build a culture and a set of products and services that both accomplishes that mission and makes for a stable and viable credit union business model? For Kendall, it starts with listening, it leans on data, and it focuses on playing games you can win. As someone who's not always been a good listener, Kendall learned the value of listening to understand as opposed to listening to respond. When you do this, you uncover the unique perspectives and insights that inform better decisions about how you can actually help people. Looking back on the day when Kendall took the call from a recruiter asking if he wanted to come work for a credit union and having the immediate response of, hell no, to now, he's darn glad he took the opportunity and hasn't looked back. So while you won't find Kendall on the golf course, going back to the whole, only play games you can win thing, you will find him and his team meticulously making moves that help his credit union focus on the four main areas they can win at and help members win at. Kendall, I'm not going to lie, man, writing that up was absolutely a blast because I'm stoked to have you as a guest. I'm really excited that the opportunity of this podcast brings people into a conversation with me that I otherwise probably never would have had an opportunity to do. And I think 2 minutes into the first time talking to you, I was like, I'm going to be best friends with this guy. So welcome to the show.
Well, thanks. I'm really glad to be here, and I'm really glad for the opportunity to have a conversation.
Yeah. I think we're going to go a lot of different places today because I don't even think I could do justice your passion for the credit union industry. When we talk about truly helping people's financial lives and futures, and then putting it into brass tacks, sometimes those are two different things, right? And I think there's a lot of talk and a lot less action and a lot more fallback on the status quo. And it's pretty cool to talk to you because you're like, oh yeah, that thing. Yeah, no, we just killed it. You're like, wait, what? Yeah, no, we just killed it. So talk to us a little bit about just that mindset for you in the credit union. Like, how do you guys get into that headspace of nothing's really off limits? Always use the guiding light of, is this actually the right thing for the member? And then how does that kind of permeate through the organization?
Yeah. So I think in our organization, we have a set of guiding principles that in many ways reflect my personal philosophies about life and business, and also incorporates a number of the personal philosophies of our senior team. And so you mentioned in the intro, we don't play games we can't win. That is in fact one of my personal philosophies. And we carried that over to the credit union. And we said, what are the businesses that we can't be competitive in? What are the businesses that we can be competitive in? What are the things that we know how to do? And what are the things that we're really not very good at organizationally? And then you view that through the lens of, as you said, job one, our mission, improving the lives of our members, the financial lives of our members. And also another one of the cooperative principles that credit unions were founded on are care and concern for your community. And so we at Amplify have an obligation to make our community a better place it was than we found it. And so if you take all of those things and mash them together, then you come out with a different set of businesses that you choose to be in. And not like other credit unions where we think we have to be all things to all people. We pick our spots. And I think that has been really important over the 15 years that I've been at Amplify, is to continuously refine our business processes to improve the financial lives of our members and serve the businesses that we're in today.
I like that you use the word obligated. I think there's a lot of, meaning behind words, obviously. And so choosing one word over another word, while it may seem a small nuance, I think there's actually a lot of, interesting insights that can be unpacked from why you choose to use a specific word. It's not like it's your job or even it's just the right thing to do for you guys. You see it as an obligation. Like this is an immovable object for us.
Yeah, we do. And it is, and that is manifested in a whole host of different ways throughout our organization. Some people are moved to volunteer their time. Some people are moved to donate to nonprofits to help improve our community. And those that aren't moved in that way, they actually support the mission by doing their job really well and helping Amplify generate the revenue that lets us get to our communities in those ways. And so we do see it as an obligation, not it's stronger than a responsibility.
Yeah.
And so that's why I use that word. It's not in your life and in your business, you have things that are a have to, and you have things that are a get to. And so it is a part of our mission. We get to give to our community. We don't have to.
Yeah. But even then, like the way you were talking about it makes me feel like, when you use the word obligation, it's like you get to have to. Yeah, like if you're going to be a part of this, you're going to be a part of this. Yep. And everybody's contribution is going to look different, like you were saying, right? I mean, my thing may be I really like to go on Sundays and pick up trash downtown Austin, right? Your thing may be, hey, I like to make a donation to the soup kitchen every month. And somebody else's thing may be, hey, I'm a total data junkie. I really don't like interacting with people. I would like to sit in the basement and I would like to crunch numbers to figure out how Amplify can be the single most operationally efficient credit union in the known universe so we can use every penny that we have to support our community, right? Each of those contributions is unique and different, but they're adding value in their own way.
And so that's when you bring a diverse skill set and a diverse level of interest and a diverse lived experience, that gives an organization an opportunity to perform better and to make better decisions. Every bit of data tells you that the more worldviews that you can bring into an environment, the more differently abled skill sets that you can bring into an organization, you're going to perform better. And that doesn't matter whether it is in our business or as it pertains to our obligation to make our community a better place. Different people bring different strengths and they contribute in different ways. And it has been my good fortune, I'll have to say, to have been able to assemble a group of people that feel the same things that I feel, that see the world in some of the same ways that I see the world. Not that we have groupthink, but that we are aligned in our mission and our values and our service standards to each other. And service standards to each other are something that are actually really very important to us as well.
Isn't that fascinating? I think one of the things I've noticed as I've gotten older and I just start to have a little bit more world experience myself, right? Is you see some of the things that when you and I have this conversation on the podcast, it's like, I would love to think that everybody listening to us is like, well, yeah, no, duh. Like that makes all the sense in the world. But what's crazy to me is how many of us would probably agree with the statement that you just made, but then we don't actually go about living it, right? And use any example, I'll use a super polarizing one, but just even a personal one, right? I mean, you look at how divided a lot of politics in the US is right now. And I would argue one of the most dangerous things that you can do is just fill your social media timeline with all of your friends that think exactly the same way as you, right? And you're just missing out on the opportunity of hearing unique ideas and perspectives that may actually change your mind because you were closed off to some. But at the same time, I think that there's a really important distinction that you drew out, which is when we think about creating these super high functioning teams, right? You want to avoid groupthink. You want to avoid having everybody think the exact same way, but you can't have one person. Let's pick you. You can't have you as the CEO of the credit union saying, hey, that product might make us a couple of bucks, but is a bad product for members. Give it the boot. It's going out of here. And then having one of your senior leaders on your staff going, absolutely not. I don't care how much that ruins someone's financial position. That's how we make money, Kendall. That thing's staying around, right? That's a misalignment of the mission, not a different perspective on how to accomplish the mission.
So, I think it's interesting because we have a belief that how you make money is just as important as making money. And so again, there are products and services that we sunset, that we discontinued, that just didn't align with the values that we hold about how we make money and how we serve our members.
Like what?
So I often use the example of indirect auto lending. We exited indirect auto lending in January of 2020. And I thought that day that we closed that business was going to be the hardest day of 2020. Turns out there were a few other harder days that were ahead, happening in late February and early March and continuing on for a while.
As the story would have it.
But that is a product that is financially unhealthy for our members. They have 160% LTV loan for 7 years on a depreciating asset. And so they're upside down in that car for the majority of the time they own it. And that's financially a bad decision. And so we don't want to facilitate those decisions. We don't pass judgment over your need or your desire to do that. But if it's in our DNA to improve your financial lives, that's not the way to do it. And so we exited that business. I think, quite honestly, the biggest thing that we did from the perspective of it's not just the making of the money, it's how you make money. It was our decision on February the 2nd of 2022, 2/2/22, the numbers just work, right? And we made the decision on that day to completely eliminate banking fees. So in February now, 3 years ago, we turned off all fees on all deposit accounts. but we continue to provide all of the services that we provided before. They're just free. So if you need to do a wire transfer, great. There's no charge for that. If you have a commercial deposit account with us and you need positive pay to prevent fraud on paper checks that you write, great. We provide it for you. No charge for that. Remote deposit capture, it's free. You accidentally overdraft your checking account, guess what? We pay the overdraft and we don't charge you for it. And so that was a mindset shift that really took us somewhere north of 2 years to accomplish. We originally started talking about fee-free banking in 2019. And, core banking systems are built to charge fees, not to eliminate fees. And so it was well over a year to do the research and then another year to actually implement the project to eliminate fees. So it was an interesting journey.
I want to come back to that because my head can't get wrapped around this because as a consumer, I love paying fees. So it seems super weird,
But it's interesting that there are people in our trade association that will say members want to pay fees because they want the services. And I would suggest to you, they want the services. They don't want to pay the fees. And we have proven that you can run a credit union and not charge people for overdrafts, but still let them overdraft as they need. And you can do that responsibly, and you can do that and still maintain a profitable business. So we chose not to make money off the back of our member in that way. That is fee for failure. That is not fee for service.
Yeah. So I really want to come back to this whole fee structure stuff that you're doing, because for starters, I really appreciate actually that I feel like I can have this very candid conversation with you about revenue at a credit union. For whatever reason, sometimes we get a little dodgy about the subject, but I argue at the end of the day, y'all got to make money. If you can't make money, you can't do the great things that you're looking to do. You'll go out of business, right? So there's a balance. We don't want to be, greedy and charging fees for the sake of fees. But if your credit union ceases to exist, all the good that your credit union is doing will cease to exist as well.
Yeah. So we have a phrase that sums that up. And that phrase is, bad things happen to good companies who don't have revenue. And so, but again, having appropriate positive revenue, having net income is important to us. That's the way we in financial services keep score. As a credit union, the only way to grow your balance sheet and to serve more people and generate more income back to the community is to have an appropriate net income, because that's the only way we can generate capital. We can't issue stock. Many credit unions can't issue subordinated debt and use it as regulatory capital. So, it's like the old financial services commercial. We make money the old fashioned way. We earn it, but we earn it in a responsible way.
So I want to go back to, you were talking about the indirect auto lending. So I'm really curious how you guys kind of arrived at that decision. As you were talking about it, I was thinking about, I remember seeing forever ago a meme that was floating around the internet, making fun of a poor kid. But unfortunately, I think it was a good example of this happens more than, got publicized in just this event. Some 23-year-old kid who financed a brand new BMW M3 and, young finance bro started making a couple of bucks, could land the loan, but, rolled in the negative equity from his previous car into this on top of 100% loan to value for the M3. I want to say the loan was at 26.9% over 7 years. And it was something like the total interest he was going to pay on the car was 3 times the purchase price of the car by the time it was all said. And the purchase price of the car is 6 figures, right? So, we're talking about putting this kid in a massive load of debt. And sure, he's feeling pretty good at the moment, driving around downtown in his M3, feeling all hot, right? But to your point, was that actually doing a service to that person? Or in the short term, would we have really, crushed this poor kid's dreams telling him, bro, you shouldn't own this M3. but setting them up for longer term success. But conversely, so I'll use that as like one example, but conversely, I mean, I have to imagine there's a lot of positive scenarios that happen in indirect lending too. So how did you kind of weigh out the maybe doing a little bit of indirect versus just doing it completely for everyone versus shutting it down completely? Like, how did you guys go through that thought process?
So we went through the thought process about what did it really mean to our organization? And it was a placeholder asset on our balance sheet and a placeholder asset that had a lot of charge-offs in it, quite frankly. Because again, if you roll in your negative trade equity and on top of your 100% LTV, when something goes wrong, it goes really wrong. And you're manufacturing charge-offs that are in the 5 figures in many, many cases, if you look at the cost of a car today. And so it made sense for us to trade that product for another product. And it's a product that we leaned into, and that is our mortgage banking business. So here's an interesting fact that many people don't know. The median net worth of a homeowner is 40 times greater than of a non-homeowner. And so if we can help people be homeownership ready with, fee-free banking products and services, if we can help people into their first home, if we can help them move up and move up again and move up again, that gives them the opportunity to build generational wealth. And so would we rather focus on helping people build that generational wealth, or would we rather put them in an M3 at 160% LTV? Again, if you view through the lens of what's best for the financial health of our member, there's no question about which one's better. And so that was the way we assessed the decision to get out of the indirect auto business. Yeah, we still make direct auto loans. And you can't live in Texas and not have a car and go to work. I mean, this is not a public transit friendly sort of a state. And so responsible auto lending is something we do every single day. But again, we didn't want to be the junk food of financial services. It gets you instant gratification, but doesn't help you build the wealth you need over the long term.
I'm curious, and I'm going to ask this. This is going to sound like maybe a negative or accusatory statement. I promise it's not. I'm just genuinely curious. So, if you think about that, let's use that kid in the example, right? I would argue he's somebody at pretty high on the list of needs some help. Like he needs somebody to step in and say, hey, bud, this is a bad idea. Like, let's hold your hand. With you completely exiting the indirect, do you feel that misses out on an opportunity for you to have that conversation with that potential member and potentially change their course, do a course correction for them? Or I'm just curious if you guys thought about that, what that looks like.
Okay. The short answer is no, but let me give you the longer answer.
Please.
So people often look at the act of buying a car and financing a car. They look at that as one. Okay. They do it at the dealership. They show up and say, I want that car. And they go see the F&I guy, and the F&I guy puts them in a loan, and away they go. And so in most cases, these people weren't a member before. And you only have 2 or 3% penetration rate of indirect members that convert to real members. And you don't really get to have that conversation with them. It's the dealer that has the conversation with them. The dealer's not interested in their financial health overall. They're interested in selling their car and getting the flat back from the credit union or the bank or whomever they sell it to. They're not interested in improving anybody's financial life other than their own.
100%.
And so we weren't even in the conversation and never had the chance to change the conversation until it was too late.
Yeah. I think that goes back to what you were talking about earlier of you don't have to always be all things to everyone. No. And there's enough of a swath of, financial institutions that maybe that is somebody else's focus, right? I don't know. Maybe you and I'll find a credit union out there that we can bring on the podcast that's like, all we do is indirect lending. And our focus is on getting in, building that relationship, changing that course correction for them out of that. and that's all they do. And that's their specialty, right? And you can be like,
Sure.
hey, great, good for you. I ain't touching that with a 10-foot pole. That's not a game I can win at because this is how we've aligned our credit union. And so I think sometimes that's hard for people to accept. Like we try to, oh, I have to touch every single thing and try and improve every single thing. And ultimately we do a little bit across everything and not anything to move the needle in any of those. But you guys kind of took a different approach and said, hey, we're just going to do these 4 things. Not 3. We're going to do these 4 things. We're going to do it really, really well. And we're going to move the needle in each of those significantly. Is that an accurate assessment?
That is a very accurate assessment. And so the 4 businesses that Amplify is in is mortgage banking, of course, because of the statistic I shared about, the net worth, the median net worth of a homeowner. The second business that we're in is commercial lending. And so we don't do, fancy downtown high-rise office buildings. We do multifamily, apartment complexes. We do spec home lending. We do acquisition, development, and construction for people to put in subdivisions.
Yeah.
We finance, retail shopping centers, commercial and industrial properties. And so these are business owners that are driving the economy. 80% of jobs in the U.S. come from small businesses. And so if we can finance small businesses, that gives us the opportunity, again, to help improve our community by being a part of the job creator network, as opposed to, any of the other businesses that we would be in. And so as it turns out, we're pretty good at commercial lending. It is a game we can win. And we feel really, really, really great about that segment of our business, both from a profitability perspective and from a care and concern for your community perspective. The 4th business that we're in, obviously, is fee-free banking, and that supports and underpins all of our lending activities. And then the 4th business that we're in is, it's a little inside baseball, but it is loan servicing. So we have a loan production machine that generates far more loans than we can hold on our balance sheet. So we have to sell those. And so every month we're an active seller of mortgage, home equity, HELOC, commercial loans. All of those things go into the secondary market. Some of those go to the agencies like Fannie Mae and Federal Home Loan Bank. But many of those assets go to other credit unions that need very high quality, good earning assets on their balance sheet. So, many credit unions are down around 60% loan to deposit. We're north of 90% loan to deposit.
Wow. And
so what we're doing is giving other credit unions an alternative to much lower yielding treasury securities and investments that they would have on their balance sheet. And so one of the cooperative principles is cooperation with other cooperatives. So we're sending about $9 million a month in interest income into the credit union system to people who own loans that we have originated and they've purchased. As a matter of fact, we service more loans. We have more off-balance sheet loan servicing assets than we have assets on our balance sheet. And when you're capital constrained, you heard me say earlier, the only way to grow your balance sheet is through your net income. And so growing off-balance sheet assets is the way to not diminish your capital. And the other thing that's beautiful about that business model is we get paid a very small fee to service those loans for other credit unions and banks. And yes, I said banks. We've sold lots of loans to banks. We don't think they're the enemy. And so we generate revenue that is paid to us by other financial institutions to service loans on their behalf. What could be a better benefit for them?
Kendall, how many members do you guys have?
We have right around 50,000.
About 50,000. What are your assets right now?
So we have just under 1.4 billion on the balance sheet. And I looked this morning and we have 1.55 off balance sheet. So total, just under 3 billion in total assets under.
Crazy. And so, obviously that comes from the higher mortgage and commercial lending space.
Right.
I got to ask though, and my wife's going to ask me immediately after I end this recording if I ask this. Do you guys do commercial lending for donut shops?
For the right donut shop.
I don't know what it was. So the context behind this is we were looking at moving to the Fort Worth area, and we were scouting around, and my wife was like, what is with these Texans and donut shops? Like, there are more donut shops than gas stations. Like, these things are everywhere.
We've never financed a donut shop, but maybe just the right opportunity has never come along. But we've done all sorts of things. We've done several breweries, and that is not normally in the credit union wheelhouse, right? But as it turns out, we know a thing or two about financing breweries and stuff. There you go.
How'd you get into that?
Well, somebody in our organization took a little detour from banking for a couple of years and built a brewery, and that somebody would be me. And so learned a thing or two about the brewing business and came back to banking. And then all of a sudden, craft brewery lending opportunities present themselves to us. And yeah, one thing leads to another, and there you go.
That's crazy. Our breweries, so I'm in Portland, like right at the start of wine country. And I think there's just thousands of wineries right outside my house. People always ask, how do you become a millionaire in the wine business? And the answer is you start as a billionaire. So is that true for the breweries too?
It is. Yeah. But my joke is I made a small fortune in a brewery because I started with a large one. So it's the same joke.
Yep.
But yeah, I mean, it's an interesting business. And of course, when I was in that business, I was maybe ahead of my time. This was in the mid-90s. And so it was really well ahead of the craft beer wave that came in the 2000s. So
yeah, I mean, Austin's a mecca for that now.
It is.
Yeah. Well, okay. So let's talk a little bit about those two lines of business, because I think if I just look at kind of industry data and the conversations I have both in my day job and doing this podcast, there is, don't get me wrong, a lot of credit unions doing mortgages, doing commercial lending, but I don't hear this is, one of our core top 4 areas of focus. So what kind of spurned that for Amplify, and, how has that been, I guess, made kind of your standard business model, and how have you guys turned this into such a successful practice that you're able to sell off these loans and service them like that?
So the short answer is to have a team that is highly experienced in those businesses that understand commercial credit, that understand the mortgage banking business and how fulfillment wins the game better than sales on the mortgage origination side of the house. And I think our success is really borne out by our net charge-offs. So we're essentially servicing $3 billion worth of loans, $1.3 billion for our own account. And our net charge-offs last year were about $500,000. And the year before that, it was $70,000. So essentially it rounds to zero. And so that is the very definition of playing a game that you can win. And we've proven over the long run that we have the ability to look into a credit profile and assess it very, very well. And so I think that as those businesses have grown, we've become more successful at it, and success breeds success.
I've used this example a couple of times on the podcast, Kendall, and maybe I'll keep using it until like somebody solves this and I don't have this as an example anymore. But what's funny is it got validated the other day. I was flying home from a trip on the East Coast and ended up talking to this woman in the seat next to me. 20 minutes left in a 5-hour flight, and we both laughed and said we wish we'd started the conversation at the beginning of the flight, not the end of the flight. But the example I use is one of my really close friends and neighbors who has a daughter and a son almost the exact same age as my kids, and they've basically grown up together, is a dentist. And he is a first-generation Romanian immigrant, both he and his wife. They put him through dental school with epic levels of frugality. He, focused on keeping their debt to an absolute minimum. They focused on paying off what little student loan debt he did take on through dental school. Long story short is he's a dentist my age with zero debt other than his home. And Kendall, this guy is trying to buy a practice and cannot get financing to save his life. And what I find fascinating is if you actually look at the data, dentists actually have one of the lowest default rates of any segment of buyers in the US. So fast forward to just recently on this flight, I ended up talking to this woman. Long story short, she was flying back from DC. She was on like the Today Show or one of the morning shows talking about how some simple changes in kids early on can prevent them from having braces. And we get to talking. She's a dentist. Her husband is a dentist. Same kind of thing. First generation Indian immigrants, both dentists, both have got zero student loan debt. They both do now own their own practices. So they own 2 practices. But she was telling me about the absolute nightmare of trying to get financed. And ultimately, like her clinic, she just worked out a personal arrangement with the seller of the clinic and did personal financing through him for the longest time until they could finally move it over to a financial institution. And I use that as one of many examples to say, going back to, I feel like I talk to a lot of credit unions and I don't hear them say things like, small business, commercial lending is the backbone of this country. And it's an area we want to focus on because it'll empower our communities by not only building up businesses, but building up, paychecks for the people that work at those businesses. And then I hear stories like this of people that are struggling to find financing. And like, for me, maybe I'm missing something massive in this equation here, but I'm like, y'all are the answer to this thing.
And so really it is, and dental and medical practices are the easiest things to finance in the world because they have very, very, very stable cash flows. And so, most of these practices, now a startup practice is a little harder, right? Because it has no reliable revenue base. But if someone's buying a practice, this dentist has had his same set of patients for ages, and the revenue is very, very stable, very reliable. And so it's financial institutions who aren't really willing to take on that segment of a business. And we've done a couple of those, not many, because that's just not really our area of expertise.
Mm-hmm.
We do more in real estate, but those are the sorts of businesses that we would finance all day long. Purchases are really easy.
Well, and that kind of goes back to what you were talking about earlier, right? I think maybe if you could expand on, you were talking about how you've seen so much success in those business lines, specifically, small business lending and mortgages, is you have experts on staff where that's kind of, they understand it. Again, I'm probably overgeneralizing, so don't beat me up in the parking lot at GAC next year. But, if you don't understand something, you see it as a risk, right? So if I'm like, hey, look, I don't understand dental practices. I ain't lending on that thing because I got no idea how to value this. Then I could see how you would stay away from it. But if you bring people on staff that are experts and are like, hey, look, like I've facilitated a handful of these transactions, maybe in a different industry or something like that. I know how to look at these balance sheets of these dental practices. Then all of a sudden that becomes a lot less scary, probably, right?
It does. And so the thing that's interesting, and I am entering my 46th year in financial services. So I've done this a little while, and it might not surprise you to learn that the majority of the time I spent in financial services has been in commercial lending and in mortgage banking. Surprise. And again, these are the things that we know how to do. And we took a traditional community FI worldview and brought it to a credit union that gives us the opportunity to do what we know how to do, but do it for the right reasons. And so I think that differentiation in mindset, realizing that we can't be all things to all people. And so strategy, I don't think people appreciate this as much as they should. Strategy is also what you won't do. And so that has been a part of their strategy for a decade and a half. These are the things we won't do. These are the things that are background noise. and detract away from what our real mission is and what our real area of expertise is. So why be in a business that simply distracts you from focusing on the things that are most meaningful to your organization?
You were talking about building generational wealth earlier. And when you talk about that from a personal standpoint, right, one of the things that usually comes up as a part of that is to diversify your revenue streams, right? Make sure you're not solely dependent on one set of all your eggs in one basket. If you apply that concept to you all, I'm curious how, so, a lot of times I talk to credit unions, community banks, right? And we're talking about how to improve both our net interest margin and, our revenue that's not tied and is not, is fee-based, really. You guys killed off one of those streams, so you're a lot more reliant on the other. How do you kind of plan for the ebbs and flows in the economy, changes in the rate environment, instability in just whatever may be happening in the news? Like, how does that impact your strategy?
Well, so, it's interesting because if people want to try to predict, for example, the direction of interest rates, that is a fool's errand. Even really smart economics people only get it right about 20% of the time.
Yeah.
And so if you're in a business where you're wrong 80% of the time, then you may as well be wrong 100% of the time. And so whatever your strategy is, you pick your poison. And so let's say that you are in the credit card business and you have a very large unsecured credit card portfolio, which, by the way, we sold ours a few years ago and got out of the credit card business. And the economy goes in tank and unemployment surges. You see your charge-offs in your credit card portfolio go through the roof. And so, traditionally, the first thing that people pay is their mortgage payment. That's the first thing that they're going to pay. And so that traditionally has very low delinquencies, very low charge-offs. Now, I'm not going to lie to you. The mortgage business has not been any fun in the last 2 years since we've seen rates run up so dramatically.
Yeah, I bet.
But I think people are now coming to the realization that they're never going to see 2.5% mortgage rates ever again.
It's a hard pill to swallow, huh?
Yeah, let's put that notion aside because it's not going to happen. But no matter what business model that you have chosen, there's going to be some risk in that business. Again, if we see an economic slowdown, we're going to see delinquency rates on autos increase dramatically. The same thing goes with student lending. And so no matter what you're in, it has a parcel of risk. And so we're not in the business of avoiding risk. We're in the business of managing risk and understanding the risks that we take and have a balanced and well understood risk appetite for whatever business segment that we're in.
Yeah, that makes a lot of sense. I mean, I think, we were kind of talking about this before we started recording, right? You can almost, pick up a newspaper each week and find the new thing that's the reason why everything's going to hell in a handbasket, right? So there's always going to be those ebbs and flows, and that's just kind of a part of life, right?
So, there has been a black swan event every 90 days for the last 5 years. And you can't predict the future. The only thing you can do is manage the now. And so there's a lot of background noise about things that are popular in the financial press today, whether it's tariffs or whether it's, taxes or tax cuts or whatever the case may be. And so the only thing that we can do is control the things that we can control. We can't manage the segments of the economy or the economic decisions that are out of our control. We can't control what the Fed is going to do with interest rates. We can't control what Congress is going to do with taxes. We can't control what the president is going to do on tariffs. The only thing that we can do is control our reaction to them. And, you can contingency plan, and you should, but, don't predict the future, control the now.
Yeah. I mean, I think this goes to your ultimate driving mission, right? Which is just help the member. And if that's kind of always the guiding light, how you get there may change. But as long as you've
Right.
got thought processes around how to maintain a stable, viable credit union and balance sheet, and put the focus on, all right, we may go ups and downs. Our goal is to weather the storm so that we lessen the impact of the storm on members. Because let's face it, at the end of the day, I mean, I might get a little edgy on this, but the vast majority of us, we don't really care about all the stuff that's in the news, right? I care about the impact that it's going to have on me. And what do I care about the most? I'm a husband and I'm a father of 2 little kids. I tell you what I care about the most. I care about keeping this roof over their heads. I care about keeping their bellies full of food, right? I care about keeping a smile on their face and making sure that they don't see a struggle, right? And so everything else is kind of just noise that I'm just trying to navigate. And that's kind of what you're trying to do too, right? Like you're kind of navigating that storm of whatever it may be, changes in, politics, changes in governance, changes in regulatory, changes in innovation in the environment. You're not in a business to go out and sell 1 billion widgets and IPO and make a ton of money. When you sign up for a credit union, that's not what you're signing up for, right? It's a very different mission. So I think you have a different mindset about what, the changing landscape means for you.
So, the thing that tells us that we have been successful is that our members don't have to think about us too much. They, in many ways, we're like your utility, and you don't think about it until the power's out.
Yeah.
And you don't think about it until you can't access online banking, or you don't think about it until something goes sideways, until something goes wrong.
100%.
And so our mark of success is that people aren't thinking about us too much. They're thinking about us just the right amount. We want to be in the considered set when they're going to change financial institutions. We want to be in the considered set when they open their first account. We want to be in the considered set when it is time to get a mortgage or to have a small business loan. And then once those things are in place, we want it to run on autopilot like clockwork. And banking is a really ugly business with a nice coat of paint on it, because to do all the things you have to do in banking, that you have to deal with more vendors than would fit in my home here today, quite frankly. And it's a hard business that runs on a lot of outsourced activity. And I don't think many consumers realize that.
Yeah. That is a kind of an interesting element that for a community financial institution, like that reality is, for all intents and purposes, we're very much so a commodity business, right?
Mm-hmm.
And I think sometimes even in my space and what we do for credit unions, right? Like sometimes we get on this high horse that like, we're going to be the best thing since sliced bread. And I'm like, yeah, you know what? Like, no offense, but a member's only coming into the credit union or logging into digital banking because they need to accomplish something or they need to learn something. Pretty much outside of that, they really couldn't care less, right? Like,
Right.
I'm not their best friend. I'm not their favorite digital solution to hang out in. I'm not the thing that they're probably going to be showing off to their friends. Look at this super rad thing, right?
Right.
So
one of the things that we do in realization that we are like so many community FIs are highly dependent on our suite of vendors, is every year in January, we have a partner summit, and we have both an in-person and an online component. And we have all of our key vendors and partners from all segments of our business attend either in person or virtually. And we go through our business plan and strategic plan.
Dude.
Because, because our strategic plan is not rocket surgery, right? It is, we'll give it to anybody that wants it. You just have to have the fortitude and the team to run the play. And you also have to exit a lot of businesses. So in the event, we're not shy about sharing that information. And what we found, we've been doing that for about 4 years. And we found that our partners operate as a more cohesive set because we've set an expectation for them and we share with them our service standards, and service standards are universal. They go throughout our organization. And so they're the standards that we provide service to members. They're the standards that we provide service to each other in the credit union. And they're also the service standards that we hold our partners to. And if everybody's on the same page, it seems that it works a heck of a lot easier.
I tell you what, Kendall, man, I'm so glad you said that. I had no idea we were going to go down, this path today. Out of respect for the financial institution and the consultant, without being given express consent to be able to share this information, I'll refrain from using names. But, sometimes we get into conversations with credit unions, community banks, and it's like their strategic plans are this walled garden. It's this big secret sauce that they don't want to let anybody into. And, like you, I really strongly believe that this is a marriage. I mean, this is a long-term commitment we're making to each other, and we're hyper dependent on each other's success. So I don't know if I don't know what success looks like for you, how am I able to help you meet it? And so this credit union and this consultant recently that we were working with, Kendall, when we got into the initial stages of the evaluation, I about fell out of my chair with the amount of documentation they shared with us. They had gotten their entire senior leadership team, management level team, all aligned on one core set of strategic objectives, departmental strategic objectives, how they would define success, what it would look like, all of this stuff. Their mission, vision, values, the operating plan they shared with the board, everything. And they put it in this beautiful Dropbox for us and just handed it to us. And I was like, this should be the blueprint. This is amazing. I actually understand what success looks like for you. I feel like I can actually come in and have a conversation with you now about what that's going to look like. And it was really, really cool. And, hopefully they listen to this and they know who they are, because man, do you deserve some bonkers credit for this. It took a lot of work. And I think it took a lot of guts for them to be willing to be that transparent with not just us, but all the vendors that they were evaluating and say, look, we're going to give you the playbook. Just do you use it? And I thought it was a really cool approach because it puts you at the same seat at the table.
Yeah. Well, I mean, if you know where you're going, you'll know when you got there.
Yeah.
So,
yeah. Hey, I want to come back to though, this whole fee-free thing, right? Okay. I made the smart ass joke like, oh, that's weird. You guys eliminated them. Like, I thought people love those things, but people don't. You're right. Like, we don't want to pay a fee. I mean, I would argue that maybe if somebody offered me something exceptional that I had to pay for to get maybe something above and beyond something else, then maybe I would pay for. But yeah, by and large, it's really annoying to have to pay a stupid fee for something. I'm like, I just want you to absorb this as a part of your business cost. And maybe the fee gets passed on to me somewhere else. Like, you're making your money somewhere else. But why do you got to call it like my friggin' Comcast bill? I mean, it's like $100. Right. And then it's $400 worth of little fees throughout the lines. I'm like, could you guys just tell me my bill's $400? I don't need to know. I have to pay this stupid fee. So again, maybe take us back in time to, you said this was like a 2-year project. So what were some of the conversations that happened leading into that? What were some of the decisions that you made? How did you take action on those? And then what has been the impact?
So the origin story is sort of interesting because we had a consultant do a presentation about what motivates people in financial services and what motivates them to switch from one FI to another. And unsurprisingly, this consultant shared with us that customers don't like to pay fees. And I'm thinking, well, yeah, I hope we didn't pay a lot for that sage advice. I think everybody knows that. And so as we were debriefing over a cocktail after the meeting was over, I threw out the ridiculous suggestion, if members don't like them, how about if we just stop charging them? And, credit unions are a product largely of their birth. And so we started as the IBM Employees Credit Union in 1967. And so we have, relatively affluent members that are relatively fee averse. And so as compared to our peers, we always had a lower non-interest income from banking fees than they did. And so my logic was, look, we can turn a weakness, which is low fee income, into a strength. We can walk away from income that we don't feel good about earning anyway, because what sort of world does it make sense for me to charge you to borrow your money? And we can fix what's wrong with banking. And we can do this. And of course, everybody thought I'd completely lost my mind. And so I decided I was going to just harp on it for a while. And so I did. And we talked about it. And people started to come around. Oh, this is how we can offset that income in some form or fashion. And so we went on to do some more research that told us that our higher balance account generally are more stable and have less debit card interchange. And our lower balance accounts are debit card swipers, and they have much higher interchange. And so we made the decision that we were going to offset that by promoting debit card use among lower balance accounts, and then using the higher deposit balance accounts to help with our net interest margin to fund our loan portfolio. So today we're at 99% loan to deposit. And so we have a tendency to always run very hot because we're a credit union, not a savers union. And so we think we exist to grant credit. And so we did probably a year's worth of research, and we wanted to tread carefully because this is a one-way door for us. This is not a decision we can unmake in 2 years or in 5 years when we say, it didn't really work out for us, never mind. And so this was an irrevocable decision. And so we felt like we needed 98% of the available information to make the decision. And that's what took us so long. And then it took a while to figure out in our core to turn off charging fees, because core banking systems are built to charge fees, not to not charge fees. And so that was a task. And so, from concept in 2019 to go live in February of 2022, that's a pretty long runway for a crazy idea. And so we remain the only full service financial institution in the US that is completely fee free on the deposit side. We really hoped others would follow us.
Why do you think they haven't?
Because it's easy money, and nothing that's worth doing is easy.
Yeah.
And so we really came to believe that was a moral imperative for us, that we did not want to make money that way. It was wrong for us to make money that way, to make money on the back of our member. And so that became kind of a crusade for us.
I'm making a wild speculation here, so please tell me if I'm crazy or off base. As you simplified your product lines and played more games that you knew you could win, I have to imagine that made that decision to go fee-free a little bit easier too, right? Like going back to the default rates on indirect auto lending, right? It's like, hey, look, I mean, we're lending out this money so you can get this car. We're hoping we're going to make some money back off of it. But if we've got to eat a bunch of charge-offs, if we've got to eat a bunch of, NSF fees to, transfer money over to take the payment for this loan, you got to charge some fees to offset some of that. But if you eliminate those types of business, does it make the decision easier?
it does make the decision easier. And the thing that we did ahead of going fee-free is we have one checking account. We have one money market account. We have one savings account. We have a CD, but it's the same CD. It just has different terms. And so we even simplified our suite of product offerings because, why have 3 or 4 different flavors of checking account if you're going to hang your hat on fee-free?
Yeah, I can see that. Because a lot of the reason why you'd have multiple different types of accounts is different tiers, different rewards, different fee structures based on, but if you've eliminated all of that, then what's the point of the complexity?
Then what's the point of that?
Yeah.
And so it was it caused a lot of confusion among our peer credit unions because they hadn't considered that previously. And so NSF data for credit unions, NSF fee data for credit unions above $1 billion was on every call report in 2024. And so we pulled the data in aggregate and we looked at it, and fully 1/3 of credit unions in the U.S. would not be profitable without NSF.
Damn.
And I think that over the long term is a threat to our tax status.
Yeah.
Because that is not the definition of service to your member. Those are fees that are built on the back of your member. And if your game is improving the financial lives of your members, then you're playing the game wrong.
I don't want to speak for him because 1, I'm not that smart. 1, I don't have as good of an accent. 2, I'm not as snarky, but mostly I'm just not as smart. But I know Ron Shevlin has a whole thing on like the junk fees. And I think there's a lot to that, Kendall. I mean, I want to be, respectful of, it's like you were saying, I mean, if your credit union would be non-profitable if you eliminated those, I mean, you have to rethink a lot of things, right? Before you can just go one day and say, we're going to completely eliminate that fee. Because then that takes us back to the conversation we had earlier of if your credit union has to shut its doors, then yes, maybe you're charging this NSF fee that people call a junk fee, but maybe you're doing a bunch of other good in another area that would also disappear if your credit union disappeared. So I want to be respectful of kind of the nuance of this. It's not as simple as black and white, but at the same time, I'm kind of with you. Like we need to start thinking about, do we need to change the status quo? Do we need to change the way in which we make money so that if all of those fees were eliminated overnight, we're still a profitable credit union like you are?
And even though our fee-free idea was 3 years in its making, the remaking of our business didn't happen in 3 years. I look at my tenure at Amplify, and I break it down into a small handful of seasons that I was responsible for. So when I got to Amplify, we had a fairly significant delinquency and charge-off problem in 2010. And so the first 3-year period that I spent at Amplify, it was fixing that delinquency and charge-off problem and in fixing our balance sheet. So that was a 3-year project. The next 4-year project was rebuilding our lending operations and learning, building the enabling structures to make better credit decisions. And then the next period was equipping our systems to move us into the next phase, doing a charter change from a federal charter to a state charter, doing a core conversion to a modern core. When I got here, our member numbers had letters and decimals in them. And I was like, how in the world does that work?
Nice.
And
you thought members didn't know their member number by heart now. Think about it then.
And so it's really interesting because I had to suspend my disbelief. But eventually we did a core conversion because we knew we had no choice if we wanted to be able to be in the businesses at scale that we were in. And then the most recent phase has been, navigating the interesting times that we've had over the last 5 years. And at the same time, standing up fee-free commercial banking. And so so I look at the seasons of my career at Amplify, and we launched fee-free banking in June of last year. And I'm looking forward to discovering the next season of my career here.
I think that's another interesting way of looking at it, Kendall. I mean, so many times what's the word I'm looking for? Like, there's almost a doubling that happens in the energy around a movement of things, right? And so when you look back in time, or I guess when you look at it today, you're like, oh my gosh, like Kendall woke up one day after a presentation and said we should go fee-free, and then a year later they were fee-free. That's crazy. But in all reality, like you outlined, it actually took a very long time to get to that point. But without the previous steps, you would not have been able to have that revelation of we're going to do this. And so it was kind of that compounding, almost like a compounding of money. It's like if I put in $1 now, and then I put in $1 tomorrow, and then I put in $1 tomorrow, like it doesn't feel like I'm doing much. But if I just close my eyes and I wake up 10 years later, I'm like, oh, holy crap, I got a bunch of money, right? The same kind of thing. It's like you may have felt like you were just doing little incremental steps, but they kind of built all on each other to where all of a sudden it looks like you're making these massive leaps, but they're just built on smaller leaps that you've taken to get you to this point.
So, and there are times that we at Amplify do things, but we don't exactly know why we did them. And it becomes evident to us down the way. So I'll give you an example. Late 2018, early 2019, we eliminated desktop computers and everyone operated off of a laptop. We built the infrastructure to a rock solid VPN where essentially all of our employees are operating off of a Meraki router, always connected to our network. And we didn't know exactly why we built that security infrastructure in 2018. In March of 2020, we found out exactly why we did. And so it's interesting, before the pandemic, we had one remote employee who lived in Minnesota. And today we have employees who live in 22 states. And
Cool.
we're primarily a remote workforce.
Yeah.
And so it's interesting. We're enjoying our NCUA exam this week, and the examiners are in our office and I'm at home. So I think that the irony may be lost on the examiners, but and then having the ability to do remote work and embracing remote work gave us the opportunity to hire the right people who didn't necessarily live in Austin, Texas.
Yeah.
So our head of commercial lending lives in Winston-Salem, North Carolina. Our head of commercial banking lives in Wisconsin. Our head of product management lives in Florida. And so this has given us the opportunity to find and hire the best talent wherever they are. They don't have to be in.
I got to ask, what do your peer CEOs think about you?
They can't figure that guy out because I have a tendency to question everything. I like to have information that I didn't have previously. And the only way to do that is to ask a lot of questions and then listen to the answer instead of having a preconceived notion of what you think the answer is going to be.
That's why I've loved doing this podcast so much, Kendall. I'd like to think we're kind of kindred spirits in that sense. Like, I like to ask a lot of questions, and it's not because and I think how you ask the question and the attitude and the tone in which you ask it has a big part in how it's perceived. But like with you, I get the sense that it's like when you ask the question, I'm not asking you this question because I think you're stupid or I'm questioning your judgment. I'm just genuinely curious. I'd like to know, why did you do that way? Because sometimes the answer to that is, well, shit, I don't know. Like I pulled that one out of thin air. Or sometimes the answer is, I did a ton of research and here's my research and this is my logic. I'm like, wow, great. Then it sounds like you put in the effort. I love that. I didn't understand that. And now I'm better informed because of that. And I feel like that's what I get out of this podcast is like, I get to talk to you and I get to ask you questions like, what were you thinking when you were going fee-free, you knucklehead? But like, my intention is, no, I'm just genuinely curious. Like, what were you thinking? Like, I'd love to understand your thought process. I think that's really a cool thing to be able to do.
And, the ability to have a radical transparency culture and to ask questions internally is super helpful, because I, as CEO, don't really accomplish much with my own hands. It is only through the best efforts of the people on my team that we accomplish our goal, whatever that goal might be. There will be oftentimes a vendor reach out to me and say, you need this product or this service. And it's like, well, maybe, but I'm not the decision maker on that. I'm not going to talk about what our loan origination system is for our mortgage banking unit. I'm not the decision maker on that. Someone else is. And it is an understanding that my real job is to remove the obstacles to success for the people on our team. I want them to be successful here. I want them to be happy here. I want them to be challenged here. And so my job is removing the obstacles to all of those things.
Yeah. Again, I think that goes back to what we were talking about earlier too. Is when we say those types of things out loud, like that makes all the sense in the world, but it's amazing how sometimes we just don't live it in practice. Right. And sometimes you almost have to change the perception of people. I have a guy on my team, Kendall, who's absolutely brilliant, and he's a young guy. And if you look at his, LinkedIn, it's not going to show huge resume. It's not going to show huge title. And he's one of our business development representatives. And we were looking at sourcing a product for that team to use. And the salesperson just could not get it through their head. Even when I straight bluntly told them, I was like, I may sign the contract, but I am not the decision maker. He's the decision maker. Sell him. And they're like, no, I got to sell the title. I got to sell the title. And I was like, dude, I'm never going to touch this thing. He's going to touch this thing daily. So I want him to be happy with it. My job is just to remove that roadblock for him. And the roadblock is to provide him with the technology that he wants to do his job well. So I'll sign the contract, but I'm not making the decision. Whatever he comes to me with and says, barring it being like 10x the budget, he's going to get it.
Right.
But it's funny how people are like, well, no, organizations don't really empower people to do that. I'm like, actually, some of them do.
Some of them do.
And you'd be amazed at how fast they can move and what they can accomplish when you do that. So I want to close out the thought of, your peer CEOs don't know what to do with you. What about regulators? So you said you've got them in the office right now. How do they look at just kind of this non-traditional approach that you guys have taken?
So they're quite confused by the fact that we're not a car loan credit union. And so they will look at our balance sheet and will say that, you've got a concentration in 1 to 4 family real estate. Yeah. And you've got interest rate risk. Yeah, but we've got a hedge. We've got derivatives on our balance sheet to hedge against rising or falling rates. And so we're employing practices that aren't routinely used in credit union.
Yeah.
We have this big off-balance sheet asset called servicing rights, capitalized servicing rights. We've got hedges on that against rising or falling interest rates. And so it has taken some time for them to understand our business and to be comfortable with it. We've got well more commercial loans than most credit unions have on their balance sheet. And, commercial loans risky, they say. And it's like, well, they can be, but if you understand credit and you monitor them properly, you manage that risk. So it's been an educational experience. We've been teaching them. So
I was gonna say it probably gets really interesting too if you like build a relationship with a regulator over a couple of audits, and then you get a new one, and you're like, ah, crap, I got to start this all
I got
over
to start
again.
over with this guy.
Yeah,
Yeah.
man. I tell you what, it's gonna sound so dorky and cheesy, but this is what I completely never expected the podcast to become, but I'm so thankful that it's become, is this opportunity to meet people like you that I don't think I would have otherwise had the chance to meet. It's really cool to just, like we were saying earlier, like hear diverse thoughts, opinions, ways of going about it. Nobody's way is perfect, right, wrong, or indifferent. We kind of pick our own paths, and I'm just curious to see what people picked and why and how they're doing it. And honestly, Kendall, it's really rad to see that you guys are just being really successful with making your own way and kind of challenging that status quo. So kudos to you.
Thank you. Thank you. It's been a wonderful ride here at Amplify. And, you know, I'm really excited, as I said, to see what the next chapter is.
Well, and, you know, peers may call you crazy or not know what to do with you, but I tell you what, there's one thing they can't say, and it's, they definitely can't say that you're not passionate about, I would say, the right things, which is the focus on the member. So I'm also just really excited to see people like you in this industry that, again, are just unabashedly focused on that core principle. I'm here where I am because a credit union took that mindset on me, right? And so I want to see more credit unions out there just killing the game, helping people's financial lives, helping their futures. And that's what you guys are doing. So again, kudos.
Well, thanks. And as I say over and over again, member care is job one. So that's what we're here for.
Well, before I let you go, I got two final questions for you, sir. So first off, where do you go to get information? How do you stay up to date on what's happening? How do you keep an eye on the risks? What are your go-to sources?
Everything, everywhere, all at once. And I'm a ravenous consumer of information. I start the day, of course, with American Banker. That is a must read. I read, of course, the New York Times, Washington Post, South China Morning Post, The Guardian. And those four are really my news sources, but I always have CNBC humming in the background so I can, in a web browser. And I'm constantly looking there. I keep the 10-year treasury and I keep the 2-year treasury up all the time. So I'm constantly checking those. And so it is just a general, never ending quest for knowledge about economics or what's happening in our industry. I've been focused a lot on payments recently because I think payments are going to be highly disruptive and may challenge interchange income in ways that we don't yet understand and many people aren't yet thinking about. That's a subject of another long discussion. But what I do is I aggregate information that is relevant to the various segments of our business, and I email it to myself. And then at an appropriate hour of the day, I'll send it on to the right person, whether it's something about payments or whether it's something about the commercial lending space or whatever it may be. And, I want to be respectful of people's time. So you're not going to get a 5 a.m. email from me, or you're not going to get a Saturday at 4:00 in the afternoon email from me, even though that may be the time that I've come across this information that might be relevant to our business. So
I love it. Well, if people want to connect with you or if they want to learn more about your credit union, how can they do that?
super easy. You can find out lots about us at goamplify.com. I'm a pretty easy guy to find on LinkedIn. And so connect with me there. I'd love to get to know you and love to hear your story.
Sounds good. Well, Kendall, thank you again. This has been an absolute blast. I've really enjoyed this conversation. You're just a fun guy to talk to, super insightful as well. And I appreciate, again, kind of talking through the actual steps to action versus just talking about the concepts. So thanks for taking time and coming to being a guest on the Digital Banking Podcast with me.
Well, I'm super glad to do it. It's been great getting to know you, and I'd like to maintain the connection.
Absolutely. Thank you, sir.
Thank you for listening to the Digital Banking Podcast powered by Typho. Find more episodes on digitalbankingpodcast.com or subscribe on Apple Podcasts or wherever you get your favorite podcasts.